Accounting Standard number 19, Leases, introduced from 1st April 2001. The objective of this standard is to prescribe for leases and ledger the appropriate accounting policies and disclosures in relation to finance, that is finance leases and operating leases. A lease is classified as finance lease if it transfers substantially all the risks and rewards incident to ownership. Title may be or may not eventually to be transferred. A lease is classified as operating lease if it does not transfer substantially all the risks and rewards incident to ownership. Leases in the financial statement of Leases. A. Financial leases. In this case, at the inception of financial lease, the lessee should recognize the lease as an asset and a liability. Such recognition should be at an amount equal to the fair value of the leased asset at the inception of the lease. However, if their fair value of the leased asset exceed the present value of the minimum lease payment from the standpoint of the lessee, the amount recorded as an asset and a liability should be the present value of the minimum lease payments from the standpoint of the lessee. The lease payment should be apportioned between the finance charge and the reduction of the outstanding liability. The finance charge should be allocated to periods during the lease term so as to produce a constant periodic rate of interest on the remaining balance of the liability of each period. Also, a finance lease gives rise to depreciation expenses for the asset as well as finance expenses for each accounting period. If there is no reasonable certainty that the lessee will obtain ownership by the end of the lease term, the asset should be fully depreciated over the lease term or its useful life, whichever is shorter. Then, operating leases. Lease payments under an operating lease should be recognized as an expenses in the statement of profit and loss on straight line basis over the lease term unless another systematic basis is more representative of the time pattern of the user's benefit. Leases in the financial statements of ledger. Number 1, finance leases. The ledger should recognize assets given under a finance lease in its balance sheet as a receivable at an amount equal to net investment in the lease. The recognition of finance income should be based on pattern reflecting a constant periodic rate of return on the net investment of the ledger outstanding in respect of the finance lease. Then, operating leases. The ledger should present an asset given under operating lease in its balance sheet under fixed asset. The lease income from operating leases should be recognized in the profit and loss on a straight line basis over the lease term, unless another systematic basis is more representative of the time pattern in which benefit derived from the use of leased asset is diminished. The depreciation on leased asset should be on a basis consistent with the normal depreciation policy of the lessor company. Sell and lease back transactions. If a sale and lease back transaction result in finance lease, any excess or deficiency of sale proceeds over the carrying amount should not be immediately recognized as income or loss in the financial statements of a seller lessee. Instead, it should be deferred and amortized over the lease term in proportion to depreciation of the leased asset. If a sale and leaseback transaction results in operating lease and it's clear that the transaction is established at fair value, any profit or loss should be recognized immediately. Next accounting standard is Accounting Standard 20, that is earning per share. In short, EPS, introduced from 1st April 2001. An earning per share, that is EPS, is a financial ratio that gives the information regarding earning available to each equity share. This accounting standard gives computational methodology for determination and presentation of earning per share. An enterprise should present basic and diluted earning per share on the face of the statement of profit and loss account for each class of equity shares that has a different right to share in the net profit for the period. An enterprise should present basic and diluted earning per share with equal prominence for all periods presented. The standard also requires that an enterprise to present basic and diluted earning per share even if the amount disclosed is negative, that is a loss per share. So, basic earning per share should be calculated by dividing the net profit or loss for the period attributable to equity shareholders by the weighted average number of equity shares outstanding during the period. For the purpose of calculating basic earning per share, the net profit or loss for the period attributable to equity shareholders should be the net profit or loss for the period after deducting preference dividends and any attributable taxes thereto. For the purpose of calculating basic earning per share, the number of equity shares should be the weighted average number of equity shares outstanding during the period. The weighted average number of equity shares outstanding during the period reflects the fact that the amount of shareholders' capital may have varied during the period as a result of larger or lesser number of shares outstanding at any time. It is the number of equity shares outstanding at the beginning of the period adjusted by number of equity shares bought back or issued during the period multiplied by the time weighting factor. Then diluted earning per share is calculated when there are potential equity shares in the capital structure of the enterprise. Potential equity share are those financial instruments which entitle the holder to the right of equity shares like convertible debentures, convertible preference shares, options, warrants, etc. For the purpose of calculating diluted earning per share, the net profit or loss for the period attributable to equity shareholders and the weighted average number of shares outstanding during the period should be adjusted for the effects of all dilutive potential equity shares. The weighted average number of equity shares outstanding during the period is increased by weighted average number of additional equity shares which would have been outstanding assuming the conversion of all dilutive potential equity shares. Potential equity shares should be treated as dilutive when and only when their conversion to equity shares would decrease the net profit per share from continuing ordinary operations. Potential equity shares are anti-dilutive when their conversion to equity shares would increase earning per share from continuing ordinary activities or decrease loss per share from continuing ordinary activities. The effects of anti-dilutive potential equity shares are ignored in calculating diluted earning per share. An enterprise should also disclose the following. Number 1. The amounts used as the numerators in calculating basic and diluted earning per share and a reconciliation of those amounts to the net profit or loss for the period. Number 2. The weighted average number of equity shares used as the denominator in calculating basic and diluted earnings per share and a reconciliation of these denominators to each other. And number 3. The nominal value of shares along with the earning per share figures.